Today, we're tackling something that feels like a really big hurdle for a lot of people. How you can actually start investing, even if you feel like, you've got basically nothing in the bank. Yeah, forget that old idea that you need like thousands of dollars just to get your foot in the door. The reality now, it's powerful. You can literally begin with maybe $5, $10, coffee money. That really changes the game, doesn't it?
It absolutely does. And the timing here is, well, it's critical. As we're looking at 2025, inflation is still a real thing, right?
Right.
Housing costs are, wow, way out of reach for so many. And economic policies keep shifting. So investing isn't just, a nice to have anymore. It's pretty essential for building any kind of real financial security.
Exactly. So that's our mission today. We want to be your shortcut. We've dug into the sources to find the actual tools, the tips, the strategies that work for beginners. Doesn't matter if you're a student, doing a side hustle, working full time, you're going to walk away with a clearer picture. So let's get into it.
Okay, so the first big takeaway, it's coming through loud and clear from everything we looked at. Just saving money. It's not cutting it anymore, period.
Mm-hmm.
And the reason why, it really boils down to one thing: inflation. That cash you worked hard for. Sitting in a savings account, it's actually, well, it's shrinking, losing maybe 3%, 4%, even 5% of its value each year, silently.
Yeah, and if you zoom out, look at the bigger picture, it gets even more stark. Cost of living keeps climbing. Wages often not keeping up.
Right.
And what we're seeing discussed for 2025, looking at current economic policies, there's this focus on tax breaks, right? But they seem heavily geared towards, high earners, corporations.
Plus, there's ongoing volatility. Trade tensions,
Mhm.
especially with China, oil producers, that creates uncertainty. And potentially tighter budgets for social programs.
Mm.
So this raises a really important question. What does all this actually mean for you?
Yeah.
Basically, it signals you might be more on your own, financially speaking, than maybe ever before.
Which just hammers home the point. Investing isn't some luxury thing. It's putting your money to work.
Exactly.
Making it earn its keep while you're sleeping, working, whatever. And the power of starting early.
Yeah.
Even with small amounts. It's genuinely incredible. We've seen the numbers. Just save $50 a month. Over time, that can really grow into thousands.
Absolutely. Compounding is key.
It completely blows up that excuse. Oh, I'll wait till I make more money. Truth is, the best time is now. Don't wait. Okay, so practical steps. How do you actually start? The good news is 2025 has some amazing, really user-friendly apps that make investing with small amounts super easy, automatic even, almost fun.
Yeah, there are definitely some great options out there now. Acorns, for instance. That one's fantastic if you just want to be passive about it.
How does that work?
Well, it does this cool thing where it rounds up your spare change from things you buy anyway, and then automatically invests that difference into like a mix of different investments. Diversified portfolios, they call it.
Ah, okay. So it spreads the risk.
Exactly.
Mm-hmm.
Great for beginners who don't want to think too much about it. Then you've got Robinhood. Very popular. Commission-free trading, pretty slick interface. You can buy stocks, ETFs, even crypto if you're into that. Better for someone who wants to be a bit more hands-on, maybe learn by doing.
Right, more active.
Then there's Public. It's kind of like Robinhood, but it adds a social layer. You can follow other investors, see what they're doing, discuss strategies. So it's good for learning from a community.
Interesting. Like social media for investing.
Sort of, yeah.
Mm-hmm.
And if you prefer something more, let's say, traditional, established, Fidelity Investments is a big one. They offer index funds with no minimum investment, Roth IRAs. Very solid, trustworthy name.
Okay.
And one more to mention is SoFi Invest. They kind of offer both worlds. Automated investing, like a robo-advisor managing things for you. And active trading. No account minimums there either, plus crypto, plus educational stuff. So lots of choices.
That's a great rundown. So with all those options, it could still feel a bit much. Is there like a single best one to just start with? Or is it really about matching your style? What feels right?
It really, really comes down to that personal fit. That's a key thing we saw. Like if you just want it done automatically, you barely want to think about it. Acorns or maybe SoFi's automated side could be perfect.
Okay.
If you're eager to learn, kind of jump in and try things. Robinhood or Public might be more your speed.
Right. Learn by doing.
And if you're thinking long-term strategy from day one, maybe like that traditional feel, Fidelity is a very strong foundation. Honestly, the best app is the one you'll actually stick with and use consistently.
That makes total sense. Find the one you won't just download and forget about. Okay, so you've picked an app. Now, where does the money actually go? Let's talk about the different types of investment accounts, because they're not all the same, are they?
Not at all. And understanding the differences is pretty crucial for your long-term plan. First up, the basic one. A brokerage account. Think of it as your general purpose investment account.
Okay.
Super flexible, you can usually take money out whenever. But any profits you make, like capital gains or dividends, are typically taxed each year. Good for goals that aren't strictly retirement.
Got it. Taxable, flexible.
Then there's the Roth IRA. This one's a powerhouse for retirement savings. You contribute money you've already paid taxes on.
Right, after-tax money.
Exactly.
Okay.
But then, all the growth, all the withdrawals you take out in retirement are completely tax-free. It's amazing. Especially good if you think you'll be earning more, be in a higher tax bracket later in life. There are limits, though. For 2025, it's $7,000 a year if you're under 50.
Wow, tax-free growth. That's huge.
It really is. Now, it has a cousin. The traditional IRA is kind of the reverse. Your contributions might be tax deductible now, which lowers your taxable income today.
So a tax break now.
Potentially, yes. But then you pay regular income tax on the money when you withdraw it in retirement. So it depends if you want the tax break now or later.
Okay, makes sense. Trade-offs.
Then, if you work for a company, you've probably heard of a 401k. This is through your employer. Money often comes straight out of your paycheck, which makes it easy.
Automatic savings.
Right. And the best part, many employers offer a match. They'll literally put extra money into your account alongside yours. That's free money. You absolutely want to get that match if you can. The contribution limit for a 401k in 2025 is much higher, $23,000.
Free money is always good. Always take the free money.
Always. And one more, a bit specialized, the HSA, or Health Savings Account. This one's kind of unique. It has triple tax benefits.
Yeah.
Contributions are tax-free, the money grows tax-free, and withdrawals are tax-free if used for qualified medical expenses.
Wow, triple threat.
Yeah, but there's a catch. You generally need to be enrolled in a high-deductible health insurance plan to be eligible for an HSA.
Okay, so that covers the main account types. That's helpful. But if someone's maybe self-employed or their job doesn't offer a 401k, what's a good starting point? Feeling a bit lost, perhaps.
Great question. For many people in that situation, starting with either a Roth IRA for that tax-free growth potential or just a standard brokerage account is a really solid first step. They offer simplicity and flexibility while you're just getting your feet wet.
Right, keep it simple at the start. Okay, so you've got the app, you've opened an account, Roth IRA, let's say. Now the big question, what do you actually buy inside that account? Especially if you're starting with just, $20, $50.
Yeah, this is where people can get stuck, right?
Yeah.
But the good news is there are some really effective beginner-friendly strategies. The top recommendation, almost universally, index funds and ETFs, exchange-traded funds.
Okay, heard those terms. What are they, basically?
Think of them like a basket that holds tiny pieces of lots of different stocks, maybe hundreds, even thousands. So instead of picking one company, you're instantly diversified.
Ah, spreading the bet again.
Exactly. For example, an S&P 500 index fund, like VOO is a common ticker symbol, holds stock in the 500 largest U.S. companies. Buy one share of that ETF, and you own a tiny slice of all 500. They usually have very low fees, too, and historically, they provide strong growth over the long term.
Low cost, diversified, simple. I like it.
Another really easy option, especially for retirement accounts, is target date funds. These are designed to be super simple. You pick a fund based on the year you roughly plan to retire, say target date 2060.
Okay.
And the fund automatically adjusts its mix of investments over time. It starts more aggressive, more stocks when you're young, and gradually gets more conservative, more bonds as you get closer to that 2060 date. It's the ultimate set-it-and-forget-it option.
Right. It manages the risk for you over time.
Precisely. Now, what if you really want to own, say, Amazon or Tesla, but a single share costs hundreds or thousands? That's where fractional shares come in.
Ah, yeah, you mentioned those.
Many brokers now, like Robinhood, Fidelity, Public, let you buy just a small slice of a share. You could put just $10 into Amazon stock, for example. It makes even the most expensive stocks accessible to everyone.
That's huge. Opens up a lot more possibilities.
Definitely. And finally, a really powerful strategy is dollar cost averaging, or DCA. Sounds fancy, but it's simple.
Okay, break it down.
It just means investing the same amount of money on a regular schedule, say $50 every 2 weeks or $25 every month. You invest that amount regardless of whether the market is up or down.
Doesn't matter what the price is.
Doesn't matter. Sometimes you'll buy when prices are high, sometimes when they're low. Over time, it averages out your purchase cost, reduces the risk of buying everything at a peak, and most importantly, it builds that crucial habit of investing consistently.
Consistency. That seems to be the magic word here.
It really is. The core advice is often, start simple. Pick one good low-cost index fund, like a total market fund or an S&P 500 fund, and just contribute consistently through dollar cost averaging. That alone is a recipe for long-term success for most people. You don't need to be a genius stock picker.
That's incredibly reassuring.
Yep.
Okay, so we've covered the how and the what, but let's tackle the why not. Let's talk about those common excuses, those mental roadblocks that stop people before they even start. Time to bust some myths.
Yeah, to do it. The biggest one, number one with a bullet. I just don't make enough money to invest.
Hear that all the time.
Right. And our counter is simple. Look at your budget. If you can afford Netflix or a couple coffees out each week, you can afford $10 or $20 a month for an ETF. It's usually not about the amount of money, it's about priorities.
Finding that $10.
Exactly. Next one. Investing is too risky. The market goes up and down.
Yeah, scary headlines.
Totally understandable fear. But here's the thing. Yes, the market fluctuates short term, but over the long haul. Historically, the stock market has averaged returns somewhere in the, say, 7 to 10% per year range, keeping your money purely in cash. That's actually a guaranteed loss over time because of inflation.
Right. The risk of not investing.
That's the bigger risk long term. Okay, another one. I'll start investing when I make more money, or when I pay off debt, or when X happens.
The I'll do it later excuse.
Yep. And the problem is investing isn't really about hitting some magic income number. It's about building a habit, like exercising. You don't wait until you're perfectly fit to start going to the gym.
That's an analogy.
You start small, maybe inconsistently at first, but you build that muscle. Same with investing. Start small now, build a habit, the amounts will grow later.
Okay, and the last big one. I feel like I'm too late. Everyone else started years ago.
Ugh, the comparison trap. Look, is it better to start earlier? Of course. Time is your biggest ally with compounding. But the old saying is true. The best time to plant a tree was 20 years ago. The second best time is today.
Right.
Trying to perfectly time the market, waiting for the right moment, that's usually a losing game. Just getting started, getting time in the market is way more important. So no, it's almost never too late to start.
Love it. Crushing those excuses. Okay, building on that, let's zoom back into the specific environment of 2025. You mentioned economic policies and potential shifts. How should a new investor think about navigating this particular landscape?
Yeah, it's a good point. We need to be aware of the context. Based on the sources looking at potential 2025 economic stances, a few things stand out. First, those tariff tensions we mentioned.
Right, with China, others.
Yeah, those could definitely cause ripples, especially in sectors like technology, manufacturing, maybe impact international funds. Yeah. So something to be aware of, not necessarily panic over.
Okay.
Interest rates. Keep an eye on what the Federal Reserve does. If inflation keeps cooling down, they might start cutting rates. That affects everything from bond yields to how companies borrow money, those corporate tax breaks that are often discussed. If they happen, that could give a short-term lift to stocks of big companies. And generally, around election cycles or big geopolitical events, you can expect some market volatility, ups and downs.
So, seems like potential bumps in the road. What's the advice for a beginner facing that?
The core advice, honestly, doesn't change that much. Stay consistent with your plan. Don't panic sell when the market dips. That often locks in losses.
Right. Resist the urge.
Exactly. Stick with those broad market index funds or ETFs we talked about. Because they're so diversified, they're generally better positioned to weather different economic storms compared to betting on just a few individual stocks. Keep that long-term perspective.
Stay the course. Diversified. Don't panic. Got it. Okay. So for people who are starting their consistent, are there ways to maybe accelerate that growth? Any sort of pro tips we can pull from the sources?
Absolutely. There are definitely ways to optimize things. Number one, automate everything you can. Set up automatic transfers from your bank account to your investment account right after payday. Even if it's just $25, make it invisible.
Out of sight, out of mind.
Precisely. Tip two, consider those roundup apps like Acorns if that fits your style. It's like finding loose change, but it goes straight into your investments. It adds up surprisingly fast.
Sneaky savings.
Kinda, yeah. Third, always reinvest your dividends. Most brokers let you set this up automatically. When your investments pay out dividends, that money automatically buys more shares, which then earn more dividends. That's compounding in action.
Let the snowball roll.
Exactly. Fourth, track your progress. Doesn't have to be obsessive, but using an app like Empower or even just a basic spreadsheet, seeing your money grow, even slowly at first, can be incredibly motivating.
Yeah, it keeps you going.
Definitely. And fifth, maybe most importantly for maximizing growth, avoid high fees, especially high-fee financial advisors when you're starting out. A 1% advisor fee might sound small, but over decades, it can eat up a huge chunk of your returns. Stick with low-cost robo-advisors if you want help, or even better, just use those ultra-low-cost index funds. Look for expense ratios under, say, 0.20%, ideally even lower.
Keep more of your money working for you, not for someone else. Great tips. And, to really ground all this theory, there's a personal story you shared earlier that really illustrates this whole journey.
Yeah, it's my own experience, actually. When I first started investing, I literally opened a Roth IRA with, I think it was $50.
50. Wow, just $50.
Yeah, and honestly, I had no idea what I was doing, seriously. No family background in it, no mentors. I just watched a ton of YouTube videos, read articles, and kind of fumbled my way through it, trial and error.
Learning as you go.
Totally. But the key was I picked a simple broad market ETF VTI, which covers basically the entire U.S. stock market, and I just started contributing consistently. Maybe it was $50 a month at first, then $100 when I could afford it, then more, little by little.
That consistency again.
Exactly. And just by doing that, sticking with it, reinvesting dividends, increasing contributions when I could, that initial $50 over time grew into a portfolio that's now well into five figures.
That's amazing, from $50.
Yeah, and the point is, I didn't need to be rich to start. I didn't need some secret knowledge. I just needed discipline and consistency. And if I could figure it out starting from scratch like that, honestly, anyone listening can too. You absolutely can.
What a perfect illustration. It really shows the power of just starting, no matter how small, and sticking with it. This whole deep dive really drives home that investing. It's truly accessible now for everyone. Your starting point doesn't have to hold you back.
Absolutely. They always say the best time to invest was yesterday. But the second best time, it's right now, today. Which kind of makes you think, doesn't it? What's one small, consistent step you can take, maybe even today, to start putting your money to work for your future?
Exactly.
Yeah.
That's the challenge. Thank you so much for joining us on this deep dive. We hope you feel empowered. Now go take that first step. You've got this.